The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So, the lead-in music to this program, we're going to be talking about money today, of course. The lead-in to the program is, of course, the song Jump by Van Halen, and it seems almost appropriate today because we're going to talk about jump or why people are jumping. You know, the market opened, and during the early part of February was down more than it had been down over 5%, almost 10%. And that was the most it's been down since early 2016. And there's a saying, I think it is attributed to Warren Buffett, but a saying which may be very characteristic and true of what we saw in early February. And that's that when the tide goes out, you see who was swimming naked. We're going to talk about that. We're going to talk about all those things. But I want to first of all start and talk about index and index funds. I've talked any number of times about the study that Dalbar does, and they repeat the study every year. They've been looking at how the average mutual fund investor does, and they now go back over 30 years. But the last study that I had, and there's a new one that's coming out. It's not out yet. I will have it soon. But the last study I had goes back 18 months ago. They looked at how mutual fund investors had done over a period of 30 years. And in the average equity mutual fund investor, the stock fund investor, their average return over the last 30 years was 3.69% versus Standard & Poor's 11.11%. Putting it in dollar terms, had someone started with $100,000 30 years ago, gotten the average return over 30 years, that would have grown to, and got the average mutual fund return, that would have grown to $286,002, which doesn't seem too bad until you realize, had they been able to invest in the Standard & Poor's 500, that $100,000 would have not grown to $286,000, it would have grown to $2.1 million. In bonds, looking at the same thing, they found $100,000 would turn out to be $122,000. Had they invested in the bond index, it would have been $852,000. So, you know, when you consider all that and what's gone on, there's this idea that if you invest in index funds, why worry about mutual funds? Why not be a passive investor? Why not just stick the money into mutual funds? Well, into index funds. You know, I want to talk about that because I think there's some real risk in doing that. When you look at the index, we use very, very often the Standard & Poor's 500. I did another program a long time ago about all the different indices and all the fund managers and the money managers who, when they can't beat the index, invent a new index. And now we have over 2,000 index to measure performance. And even with the new index, a lot of money managers who invent the index still can't beat the index that they invented. But anyway, that's a program that goes back a ways. But looking at the index, the Standard & Poor's has been around for a long time, and so it's the major stocks in the stock universe. If you look at that index and look at the others that exist, the Dow, the Russell 2000, the NASDAQ index, the Standard & Poor's seems to make sense when you look at it over the long term. You know, and this is the reason why. It started out with a few stocks in 1923. And in 1926, they expanded the index to 90 stocks. And it finally became the Standard & Poor's 500 in 1957. And what it is a weighted average mean. So they take the average price of each stock and look at the percentage increase. And that's how they calculate the Standard & Poor's 500. So each of the stocks has essentially an equal weight. The Dow, by contrast, started in 1896 by Charles Dow, who founded the Wall Street Journal, started with 12 companies, and in 1928 expanded to 30, the Dow 30 that we have now. And in that, the index is the share price. So they take the average share, or not the average share price, the current share price, and add all those together, and that gets the index. So for a stock that's selling for $100 versus a stock that's selling for $10, if the stock that's selling for $10 doubles to $20, and the stock at $100 goes up $10 to $110, even though one is doubling, one's only going up 10%, that will show the Dow went up $20 total. So anyway, that's how the Dow's calculated. Goes way back. Price of each share, 30 stocks. When there's a split, there's an adjustment for that as well. And the process until the 2000s, to understand the indexes, you got to talk about how stocks were traded. And until the 2000s, you had the over-the-counter market. And you had stocks that would move from the over-the-counter market that were traded. And in those days, prior to computers, they were traded on a teletype. So if someone wanted to order an over-the-counter stock, they'd look in the pink sheets, they'd set up to buy 100 shares of whatever stock it was. Most of the stocks that are today on the Dow and the Standard & Poor's 500, if they date back into the 1950s and 1960s, they started on the over-the-counter market. And as they moved up, and as the value of the company moved up, as the market cap moved up, it moved then from over-the-counter to the American Stock Exchange. And then as the company got bigger, it went to the New York Stock Exchange. And so the largest companies were on the New York Stock Exchange. The very smallest were over-the-counter. And they traded not with computers, but with the teletype machines and wire. Someone wanted to order 100 shares of ABCD. They would just enter that order with a brokerage house who would then put it on the wire and wire it to New York or wherever, and that would be executed. Seattle had its own stock exchange. San Francisco had a stock exchange. Chicago did. And most cities had their own stock exchange where these things were done. Now, the New York Stock Exchange, probably the most famous, was one where you have, and you've seen pictures of people at the New York Stock Exchange. You have people that make a market in a stock. A person might buy a chair, as it was called in those days. You buy a chair, you might pay as much as $1 million for a chair to have the right to make a market in a particular stock. If it was a slow trading stock, you might have 2 or 3. Your obligation was to make the book on the stock to match buy and sell orders. And if there weren't enough buys, you had to short your own inventory. If there weren't enough sellers, you had to, no, I've got it backwards. If there weren't enough sellers, you had to short your own inventory and supply stock from your inventory. If there weren't enough buyers, you had to buy the stock into your inventory. And that was the New York Stock Exchange. All the orders were wired in through a wire system, through the teletype, through Western Union, however it worked in those days. And those orders went in, and you had floor brokers who would grab those wires, run over to the person who was making the market. And you've seen the pictures of all these guys around with their orders. They're waving them, they're shouting, and there's this auction going on as orders are being matched. And that continued until the late 70s, early 80s. And then you had computers enter the market. All the New York Stock Exchange stocks were traded on the New York Stock Exchange, except as orders became bigger and bigger and bigger, there became a third-party market. You had to have a third-party market because if you had one stock that traded 1 million shares and you had only a buyer for 100 shares, somebody had to make that difference. So that was the way in which the stock exchange worked, and you moved things off. As computers came into being, you moved into a National Association of Securities Dealers automated quote system, which is where NASDAQ originated. No longer were shares traded just in New York on the New York Stock Exchange or in the particular stock exchanges and cities. All you had to do was be set up as a market maker. You could trade stocks in Nome, Alaska. All you had to do is be connected to the internet. That's how these exchanges began. And that's where we began to get the indexes. So with that, you have the index going on with a complete change that's taken place on how stocks are traded. With the Dow stocks that were originally over-the-counter stocks, instead of going through this process of the American Exchange to the New York Stock Exchange, some never made it to the New York Stock Exchange. Some began to trade. Major companies began to trade. We're coming to a commercial break. I'll come back, and after the break, we'll be talking about the index and how all this applies. Don't go away, and I have a great guest who has a healing story to tell too. Stay with me. We've got a lot to cover.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about the indexes. I've been talking about the way in which the markets work in terms of the Dow, in terms of New York Stock Exchange, American Stock Exchange, NASDAQ. So I want to come back and now talk about the index themselves. Because through all these changes, the indices have remained essentially the same thing. Their qualifications to be listed on the index have gotten larger and larger, but it's essentially the same. If you look at the Dow 30, those are generally the 30 largest market cap stocks in America, in the United States. If you look at the Standard & Poor's 500, they're essentially the largest 500 companies. And if you look at the Russell 2000, it's the largest 2,000 companies. So what does that really mean? The Standard & Poor's 500, to qualify to be part of the Standard & Poor's 500 today, would require a company that has a market capitalization of $6.1 billion. And if you look at the total capitalization of the Standard & Poor's 500, it's $23 trillion. Those companies, those 500 companies, are worth $23 trillion. To be part of the NASDAQ, you have to be $45 million in market cap. And to be part of the Russell 2000, you have to be nearly $1 billion, or maybe it's over $1 billion now. those are fairly large numbers. If you look at some of the growth companies, if you look at Microsoft, for example, it took Microsoft 14 years from the time it was zero to reach $1 billion in sales. It took them less than that time to reach $1 billion in market cap. But that time is being shortened. But what that means is those companies don't qualify to be part of those indices until they're relatively large. So what that means is by investing in index funds, you're missing the initial part of a company's growth. They have to reach a certain size before they become part of the index. That means the index is really going to trail the overall market. We call the Standard & Poor's 500 the market, but when you look at it, it's the 500 largest companies. And there's some issues with that. And the issue is only part of the market. When you look at how the NASDAQ is made up, for example, based on market cap, the bigger companies have a bigger impact. If you look at what's happened this year, Amazon's accounts for 45% of the total increase of the NASDAQ. Amazon, Netflix, Alphabet, we call Google, accounts for more than 100% of the move. And so if you go back and look at the time in 2000, I think there's something to reflect on, because if you look at 2000, the NASDAQ hit 5,000 as the index. But following 2000, by 2002, the NASDAQ had dropped 80%. The Dow had dropped 40%. The Standard & Poor's had dropped 50%. But by 2007, the Dow and the S&P 500 had recovered to where they were before the dot-com bust, before the Great Recession. They hit new highs. NASDAQ, however, still was 50% below its peak of 2000. By 2012, the Dow had recovered to 2000, and it would hit new highs by the early 2013. In 2013, the Standard & Poor's recovered to its early 2000, and it hit new highs. It wasn't until 2013 that NASDAQ, in 2013 when Standard & Poor's and Dow's were hitting new highs, NASDAQ was still down 30% from where it was in 2000. And it took until 2015 for it to equal what it was in 2000, 15 years later, and it didn't set new highs until 2016. Finally, late 2016. Maybe it's time for me to brag a little bit. My clients hit a new high in 2010. But anyway, that was me. Index funds follow a part of the market, but they don't follow the whole thing. And there's a cost to being in index funds because they change. If you look at the Standard & Poor's, it changes about 5% of the stocks every year, plus 2% out, 2% in, 3% out, 3% in. If we look at where we are headed, the research has shown that a company that started in the 1920s on Standard & Poor's index, the average life of that company was 70 years. Today it's 15 years. That means the turnover is going to be somewhere between 10 and 15% soon of the Standard & Poor's 500. Every time it changes, the index incurs a cost. For the Russell index, which is already there trading 20% of its composition, the cost is dragging between 1 and 1.5% per year. That may not seem like a lot, but over 25 years, that will reduce the total nest egg by 20%. Those are the factors. There's another factor that figures in as well, and that's where we're coming to. I've been talking for the past couple of years about how does this secular bull market end? And we've got a few more years for it to run. I think we're probably somewhere between 5 and 10 years for the bull market to run. But how will it end? I've been talking about a bout of inflation like we saw in the 1970s. And if you look at that, in the 1970s, what we saw was actually 1966, the market hit 1,000 and then was off 20%. By 68, it was 1,000 again, and then it dropped 30%. By 70, it was up to 1,000 again, and then it dropped 40%, and then it went up by late 70s to 1,000 again, and by 78, it was 79, it was down to another 20%, and then in 82, it hit 1,000 and kept going. That was where the Dow was. That's where the Standard & Poor's did. So the index was going down during that time. People invested in index funds, had they existed at that time, would have ridden it up and down through this whole period of time. But there were money managers and there were people that managed money that actually had positive returns during much of that time. So the idea that you can passively invest and invest in index funds and do as well as the market is true. The problem is you can do much better during those times of stress. The Dalbar numbers show that mutual fund managers or mutual fund investors give up a significant amount of return by switching from one fund to another fund to another fund over a period of 30 years. A huge amount of return. Investing in a passive fund can contribute to a significant loss as we go forward. And I'm going to talk more in the last half of the program about inflation and the impact and what we're seeing, because it comes back to what happened in early February. But before we get there, I want to introduce my guest, Ann Weiler of Wellpepper. Welcome to the program, Ann.
Hi.
So why don't we start with your background?
Sure. My background is in technology. I'm currently the CEO and co-founder of Wellpepper, which is a platform for interactive patient care plans. But before that, I spent 10 years at Microsoft in various roles. And prior to that, I was at a startup in Canada that Microsoft acquired. So my whole life has been in technology, and I'm applying it now to healthcare technology.
And you were not just in Microsoft in Seattle.
I wasn't. I lived in Seattle for 7 years, and then I was fortunate enough to have international experience, and I lived in Russia, in Moscow, for 3 years, running a $300 million information worker business there. So that was things like Office and Outlook and productivity tools.
Interesting. And really topical today and what's going on.
It's been interesting to see, certainly.
So let's talk about Wellpepper.
Yes.
So what is Wellpepper?
So think of Wellpepper, if you're a patient, think of Wellpepper as digital replacement for all of those instructions that you get when you go to the doctor. So instead of a stack of paper that is very hard to understand, you may get reminders on your mobile phone. You may interact with Alexa or other voice technology. You may get an SMS, and it reminds you all those things that you might need to do, like take your medication. And it also connects you with your care team at the hospital, so with your doctor or your care team. So if you need help, they can reach out and help you.
So we're going to come back to this right after the commercial break, and we are coming to a commercial break, so don't go away. And if you miss any part of this program, it will be on our website. It will be on YouTube by the end of next week. Normally, Sarah is here tweeting during the entire program. Sarah's on vacation this week, and so I don't think, unless she's listening, we're going to see many tweets. But maybe when she's back, she'll listen to the program and tweet it out so that you can dial in. You can find us on our website, adamsfinancialconcepts.com. You can like us on Facebook. You can follow us on Facebook. You can follow us on Twitter. It's About Money on both of those, About Money on Facebook, About Money on Twitter, About Money Radio on Twitter. So do check those out. And if you have questions, not this week, but next week, you can actually send us a tweet and we may answer the question on the radio.
You could tweet at me if you want. I'm Ann Wellpepper on Twitter. So that's ANNE, Well Pepper, all one word.
Okay. So we're coming to a commercial break. Do like us on Facebook, and do like us on Twitter. We'll be back after this break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Ann Weiler of Well Pepper. We just started talking about Well Pepper and what they do. So explain it in more detail, because
Sure.
a lot of times when I go to the doctor, I get 2 pages of instructions on what to do. But it seems like that's not what you're really talking about.
Well, I mean, we're talking about helping you work with those instructions. So instead of those 2 pages of instructions, you might be invited by your doctor to download a mobile app onto your phone, and that app will start to remind you when you need to do something. It might have education videos and content about whatever it is that you're being treated for, that you need to manage, and it'll enable you to record how you're doing. So maybe if let's say you have arthritis, maybe it will track whether you're taking your medication, whether your medication's working, what kind of pain you have, what are your activity levels, all of those things that you might be doing to manage your arthritis. And what we do is we break it down into really actionable and understandable little chunks of information. And then we monitor, based on those chunks of information, how well are people able to follow these instructions? And we learn from that. So we do things like analyze, what's the optimal number of things that I should ask you to do in a day if I want you to be able to do them? And we found that it's between 5 and 8. Now, that's something that you could never know from paper. I sort of put paper akin to you're just throwing something out the window and saying, I hope you're going to do this. Like we sell to large health systems, and we've seen patient instructions left behind in the parking garage. So first of all, we're really focused on making this understandable for you. And then second, reaching out to the healthcare team if you're having any problems. So if any of the results that you're recording are unusual, that can trigger an alert that goes to the care team. And they can either reach out to you through the app and message with you, or maybe they'll get in touch and ask you to come back in for another appointment. Really depends on what you're being treated for and how serious the problem is.
So when you say it monitors if you're taking your medication, if you're eating the right things, how does it exactly monitor if I'm taking my 3 pills or if...
Well, you have to tell it.
Okay.
We're not putting a sensor in a pill, but there are definitely technologies that are starting to do that. But you have to tell it. So it will remind you, hey, you need to do this now, and it'll ask you if you did it. And it might ask you how you're feeling about it. So one of the challenges, I think, with taking medication, one of them is remembering to take it, but the other is understanding why you may not take it. So we can actually start to collect that information. So if for some reason you said you didn't take it, or we don't notice you recording results for a certain number of days, we may ask you about that. Are there side effects, or are there life issues that are making it difficult for you to take your medication? So you can get a lot more insight. And once you start collecting that information, then you can apply artificial intelligence or machine learning to it to start to anticipate what might happen and to draw these insights overall.
And that information goes to the doctors and the nurses and so on?
Yeah, it goes completely secure manner, because this is very sensitive information. So everything is encrypted and is only available to your care team. We're not looking at that information. It's completely encrypted when it's sent through.
This the whole thing with the digital information has made so much more possible. In the old days, they just gave you the instructions and hoped that you would do it. And when things didn't get a lot better, they didn't know if it was because the treatment was wrong or if it was because you weren't following the instructions.
Exactly. And we're still a little bit in the old days. There are definitely places you can go and they will give you those paper instructions and they won't know whether you followed them. And sometimes, unfortunately, we'll hear from people that think that it doesn't matter what I ask someone to do, they won't do it. Well, we've proven that to be wrong. And we've proven that if you break things down, if you make it easy, if you collect just really the most important information, that people will follow the instructions. So across our whole system, we have over 70% patient engagement. So 70% of the people who are invited to this digital experience, and I say experience because it might be an app, it might be web-based, it might be SMS, and soon we'll be using voice, things like OK Google and Amazon Alexa, that people will engage with these technologies. And it doesn't, it makes sense. We're already extremely attached to our mobile devices. And so when our mobile devices ask us to do something, we generally do it. And so it's a great interface for health, and it's also something that's with you all the time.
So I have an older relative who is pretty old, who's going through a surgery, and there'll be follow-up instructions.
Yeah.
What about someone like that?
Well, we do a lot of our research with seniors, in particular because some people are skeptical about whether the seniors can use these types of technologies. And we've found that they absolutely can. And one of our design principles is to make sure that it's just easy for everyone. And certainly we can do things like if rather than delivering it on an iPhone, we might deliver it on an iPad. So it's a bigger screen interface, which makes it easier for someone to follow along. And sometimes a family caregiver might help as well. So it's helpful for whoever needs to follow that care plan.
So how does somebody get one of these devices?
Well, we will run on your own device. So your phone, you can access it through your computer, but you'll be prescribed the care plan by your physician. So we'll work with the health system to either use our templates for different types of conditions, pre and post-surgical, chronic disease management, and so on, or we can help them implement their own instructions. And then you, say you're talking to your doctor about what you're trying to manage, you'll get an invitation from your doctor to access your personalized care plan. And when you download it, it's already set up. The only things you have to do is set your personal goal, maybe put in your picture, but it all automatically starts reminding you when it's time to do something. And we have something I'm pretty proud of. We have a patented adaptive notification system. And what that means is that you get different messages depending on whether you're following your care plan or not. And so I don't know if you've ever heard of something called message fatigue, but as you get the same alerts all the time, you tend to ignore them. So what we do is we modify the types of alerts based on your own behavior.
So you wake somebody up at 3 a.m. and say...
We do not.
No, I'm just...
No, we actually have quiet hours, particularly because you don't want to be waking someone up at 3 a.m. So we have quiet hours where our app is not reminding you to do things.
So I go to the doctor and I have a procedure, and I want to have your system. Do I ask the doctor for it? How do I?
I would love it if you asked the doctor for it. If you ask the doctor for it, doesn't mean they're necessarily going to get it because, we'll work with the health systems. But certainly, if you're local here in Seattle, I can tell you which health systems to go to if you want to access it. And I think, certainly we're seeing more demand from patients for both access to their data as well as access to applications like this where they can engage outside the clinic, where they can get the information in the way that they need it. So, yeah.
There was a time my parents grew up and whatever the doctor said, they went. Today
Yes.
we live in an age where when the doctor says something, you check it on the internet to verify that you believe what's doing. You take control of your own health.
Yes, it's true.
And it seems like this really takes it a step further, because now you don't only have what the doctor says and the instructions, you have something that's going to be with you 24 hours a day.
Mm-hmm. Yeah, it certainly helps with patient self-management for sure. We know that in interviewing patients, in testing the software, that it empowers people. So, one of my favorite bits of patient feedback came from an 81-year-old, and she had 2 knee replacements. And for the first one, she didn't have Wellpepper, and the second one she did. And she told us that she would not have another knee replaced without Wellpepper. So she found it extremely helpful for her recovery.
So for the benefit of the listeners, when they go to a doctor and have a procedure, can they, you said, please ask the doctor for it. How do they ask the doctor for it?
Well, that's the challenge, is that we do sell to the health system. So if the health system has implemented, they don't even need to ask the doctor for it. But we do need help from people in helping doctors know that these technologies are out there that they could be using.
So how do they do that?
I guess they could ask, is there a way that I could get this information digitally? And it might be Wellpepper, it might be, there are other digital solutions like this. We're quite innovative, but we're not alone in this market.
So they should ask for Wellpepper.
They should ask for Wellpepper.
They should ask their doctor for it if the doctor doesn't say, we have this.
If the doctor doesn't say we have this, then they should go to our website, which is wellpepper.com, and we'd be happy to follow up on any information requests they have.
So the website again is
wellpepper.com.
Okay. Thank you very much. Appreciate it. And if you're listening and if you're coming up for a procedure, ask your doctor for this type of follow-up. I think I've known a number of people that have gone through a number of procedures. I've gone through things. It seems to make real sense. Even when you try to follow the instructions, sometimes you just miss. It makes sense to have something remind you that you needed to take the pill, you needed to do this exercise, you need to do something. So ask your doctor if they have Wellpepper. We're coming up to a commercial break. Don't go away, because I want to come back to this idea of index funds and where things can go wrong if you're doing passive investment. We'll be right back.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
Okay, so we're back again talking about money. Early February, the market is down the most it's been down since early 2016. And people are giving 2 explanations what happened. The 2 explanations are fear of inflation and fear of deficits. The January Consumer Price Index came out, was higher. January wages were up 3%, and generally wages account for about 2/3 of inflation, commodity prices about 1/3. Wages were up 3%. We were at full employment or almost full employment. Big concern, we're kicking off inflation. the Fed is going to start raising interest rates and slowing down the economy. But the other part is, the second explanation was people suddenly got worried about deficits. We had what they called the bond vigilantes out. You know, the Republicans passed the tax bill, a $1.5 trillion increase in the deficit over the next 10 years. And when you add the infrastructure and the spending bill that they passed, it's going to be $4 trillion in 10 years. And suddenly, it was not the idea that deficits don't count. That was the Dick Cheney comment that deficits don't count. Suddenly you have the what they call the bond vigilantes. These are the people that are worried about bond prices. You had the bond vigilantes out. You had bonds selling off. The 10-year Treasury, one of the most followed bonds in the world, was below 2%. It suddenly skyrocketed to 2.9% yield. The prices dropped that much to bring that out. And so people were saying it's inflation, it's concerned about the deficits. I don't believe that at all. I believe what we saw was computer trading driving the market down over a short period of time. And then people going back and trying to fit fundamental reasons for why that happened. Computers now trade somewhere between 60 and 70% of all trades that are made on the exchanges. 60 to 70%. There's really no other explanation about why a stock like Boeing can drop 20 points in less than a minute unless it's computer trading. Humans can't respond that fast. But we have computers now that instantly read the news, nanoseconds, and respond instantly to the news. So when you have a slight increase in the consumer price index, they read that, they think they preconceive in their algorithm that we have inflation, and they start selling stocks. The computer reads the news, the computers respond to that faster than you and I can read the news. They've already read it and responded to it. You know, inflation creeps up. It doesn't suddenly spring out of one monthly reading. You know, inflation is not 3% or 2%, and we're not even at 2%. Inflation creeps up. I've talked about this a number of times. If you look, inflation started picking up in 1962, but by 96 it had gone from 1 to 1.6% in 3 years, 62 to 65. From 65 to 66, it went from 1.6 to 2.9, and in 67 it was 3.1. That's creeping up. Those are years. That's not months. That's not like January to February. It's not like December to January. Inflation takes a long time. People don't suddenly decide they're going to increase prices by 10% in a couple weeks or a week or a month. And we didn't see that. We didn't see that kind of increase. We didn't see the wages increasing like that. Inflation creeps up. And yes, I believe we're going to face significant inflation in the future, but it's going to creep. It's not going to move along at a slow rate. You know, by 1972, inflation was only 3.2%. Think about that. That's a slow creeping up. And yeah, by 73, it started to jump 6.2. By 74, 11%. That's when you begin to get in. You begin to get a curve that starts to slope up and it increases more rapidly. But it's gradual and over a period of time. You know, but there were other lessons we learned from this sell-off as well. You know, volatility. There was a fund called the LJM Preservation and Growth Fund. And that fund had an online brochure that read this way. It said, investors commonly associate market volatility with instability and uncertainty. But volatility can be harnessed to target a return stream uncorrelated with the equity and fixed income markets. You know, I did a series on financial planning. I talked about uncorrelated things. I opened the program by saying that when the tide goes out, you get to see who's swimming naked? Here it is, a preservation and growth fund. How can you have a preservation in your name and do what they did? This fund on February 5th dropped 55.8%. And on the 6th, the next day, dropped another 54.6% in total. In 2 days, this fund, called Preservation and Growth Fund, dropped 80%. That's not preservation. We begin to see the tide goes out and we begin to see who's swimming naked. But they weren't the only ones. I talked about some of these things. That's what I call a chocolate-covered hand grenade. They look so good. You think, I can't wait to get a chocolate. But they're a hand grenade. They explode, And that's what happened with this fund, the LJM Preservation and Growth Fund. It blew up in 2 days, 80% loss. I believe in a straightforward, simple approach. Stocks and bonds, things that you can measure, things that you can see. Very simple and straightforward. Anytime there's anything that's esoteric, it can blow up. It's structured products, annuities, and a lot of ETFs. Speaking of ETFs, we learned a lot more about them during this time. Some specifically designed for short-term traders, supposedly lower cost than mutual funds. They had trouble trading them. Fidelity had problems. Schwab had problems. TD Ameritrade had problems. Major brokerage houses had problems. These are things which you think you're going to be able to sell when you need to sell. They had problems getting through to the brokerage houses. They had problems getting through to ask about their own accounts. These are problems. The only custodian I think didn't have problems was Interactive Brokers. That's who we use at Adams Financial Concepts. There's a reason why we use that. Finally, volatility. ETNs. Credit Suisse set up an ETN for volatility. It lost 90% in those 2 days. I think it may have lost that 90% in the first day. When you begin to get into esoteric things, you begin to see who's swimming naked as the tide goes out. This, I think there's an old saying. Saying is probably the wrong word. It's an acronym, KISS, keep it simple, stupid. That's what we try to do. We try to keep it very simple. Stocks and bonds, things that we measure, things that we can see, things that we know over the long term have produced the very best results. We try to keep it simple. KISS. That wraps us up for this week. I will be back next week to talk more about money, and we will be on KFLE, KLFE, 1590 AM. The answer about money. Talk to you then.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program sponsored by Adams Financial Concepts.